Engagement planning is a crucial process in the field of auditing involving the careful and systematic preparation of an audit. It is the initial phase of an audit engagement where auditors set the stage for the entire audit process. Proper planning ensures that the audit is conducted effectively, efficiently, and in accordance with auditing standards. Effective audit engagement planning lays the foundation for a successful audit. It helps auditors focus their efforts on the areas of highest risk, ensures efficient resource utilization, and ultimately provides confidence in the reliability of the financial statements and internal controls of the client organization. The client acceptance and continuance decision is a critical process that auditors go through before taking on a new client or deciding to continue providing audit services to an existing client. This decision-making process is essential for maintaining the integrity and quality of audit services while managing risk effectively. Some of the key components of the auditor's initial client acceptance decision includes evaluation of independence and integrity. Auditors must assess their independence from the client. Independence is a fundamental requirement to ensure that auditors can provide unbiased and objective opinions. They also evaluate the client's integrity, considering any previous ethical or legal issues. They also assess the financial stability of the client. If the client is financially unstable or facing significant financial difficulties, this may raise concerns about the ability to collect fees and the risk of going concern issues. Auditors also consider the client's reputation in the industry and assess any potential risk associated with the client's business, including legal, regulatory, and industry-specific risk. They assess management's competence. This includes evaluating their qualifications, experience, and willingness to cooperate with the audit process. They also check for any conflicts of interest that may compromise their independence or objectivity in conducting the audit. If conflicts exist, they need to be resolved or mitigated. They also set the terms for the engagement, including the scope of work, fees, and responsibilities. The terms should be agreed upon in a written engagement letter, which we will discuss later, which outlines the expectations of both parties. For the client's continuance decision, the key components are an annual risk assessment. For existing clients, auditors conduct an annual risk assessment. This involves evaluating the changes in the client's circumstances, such as management changes, financial performance, or legal issues, to determine if there are any new risks that could impact the audit engagement. The assessment of independence and audit quality is also very important at this phase. Auditors continuously assess the quality of their work and their independence in relation to the client. If there are concerns about independence, objectivity, or the ability to maintain audit quality, the auditors may decide to discontinue the engagement. Auditors also ensure that the client continues to comply with legal and regulatory requirements, as non-compliance can pose risk to the audit engagement. Because this is an existing client, auditors would also assess management cooperation. Auditors evaluate the client's management cooperation and the effectiveness of their communication if management is uncooperative or hinders the audit process. It can impact the decision to continue the engagement. The client's reputation and business stability is also considered. Auditors regularly monitor the client's reputation and financial stability. Significant negative changes may lead to a decision to discontinue the engagement. All aspects of the client continuance decision, including the risk assessment and any decisions to continue or discontinue the engagement, should be documented. Auditors should also communicate their decision to relevant parties, including regulatory bodies, if necessary. The standards require communication between the predecessor and prospective auditor. This is a crucial step in the transition process when a new auditor is taking over an audit engagement from a previous auditor. Communication between the predecessor and prospective auditor ensures audit quality, helps manage risk, and ultimately benefits both the auditors and the client by facilitating a smooth and effective audit process. Communication is essential for several reasons. Understanding the client's business and risk. The predecessor auditor can provide valuable insight into the client's business, industry, and specific risk. This knowledge transfer helps the prospective auditor gain a deeper understanding of the client's operations, which is critical for effective audit planning. Audit continuity and efficiency. Effective communication ensures a smoother transition of the audit engagement. It reduces the risk of disruptions and delays in the audit process, allowing for greater audit efficiency. It also helps the prospective auditor identify key audit issues. The predecessor auditor can share information about any significant accounting and auditing issues they encounter during their tenure. This helps the prospective auditor anticipate potential challenges and plan their audit procedures accordingly. Also, the predecessor auditor may share insights into any ethical issues or concerns related to the client's management or business practices. This information helps the prospective auditor assess the client's integrity and determine the appropriate course of action. In summary, communication between the predecessor and prospective auditor is vital for a successful transition of the audit engagement. Compliance with independence and ethical requirements is a fundamental aspect of the auditing profession. Auditors are entrusted with the responsibility of providing unbiased and objective assessments of a company's financial statements and internal controls. Maintaining independence and adhering to ethical principles are essential to ensure the integrity and credibility of audit services. It is not only important to be independent in fact, but also in appearance. Auditors must avoid situations that could give the impression of a lack of independence, even if there is no actual bias. Ethical requirements for auditors are designed to promote integrity, objectivity, and professional behavior. Compliance with independence and ethical requirements is monitored and enforced by regulatory bodies and professional organizations, such as the PCAOB. Compliance with independence and ethical requirements is monitored and enforced by regulatory bodies and professional organizations, such as the PCAOB. Failure to comply with these requirements can result in severe consequences, including legal actions, fines, and damages to the auditor's reputation. Therefore, auditors and audit firms must take these requirements seriously and continuously monitor their compliance to ensure the highest levels of professionalism and integrity in their work. The engagement letter is a crucial document in the auditing process. It is a formal written agreement between the auditor and the client that outlines the terms, responsibilities, and expectations for the audit engagement. It serves several essential functions. The engagement letter defines the scope of the audit, specifying which financial statements will be audited and for which periods. This clarity ensures that both the auditor and the client have a common understanding of the audit objectives. The letter outlines the roles and responsibilities of both the auditor and the client. It specifies the client's obligation to provide access to information and personnel, while it also outlines the auditor's responsibilities, including conducting the audit in accordance with auditing standards. The letter sets expectations for the timing of the audit, including the start and end dates. It also addresses the client's expectations regarding the delivery of the audit report and any other relevant reports. The engagement letter details the audit fees and billing arrangements. This includes information about how fees will be calculated, the payment schedule, and any additional costs the client may incur during the audit. The engagement letter also sets forth clauses emphasizing the auditor's independence and objectivity as required by auditing standards. It may also include provisions for addressing conflicts of interest. The letter may also include provisions limiting the auditor's liability in certain circumstances, such as to the extent permitted by law. It may also outline the process for resolving disputes that may arise during the engagement. The engagement letter often references relevant regulatory and ethical requirements that both the auditor and the client must adhere to throughout the audit process. The signed engagement letter serves as formal documentation of the agreement between the auditor and the client. It provides evidence that both parties have agreed to the terms and conditions outlined in the letter. An audit plan is a comprehensive document or strategy that outlines the specific procedures, tasks, and objectives that auditors will follow when conducting a financial statement audit. It serves as a roadmap for the entire audit engagement, providing a structured approach to ensure that the audit is conducted effectively, efficiently, and in accordance with auditing standards and regulations. The audit plan is typically developed during the audit planning phase and guides the audit team throughout the engagement. 3 goals of audit planning is to allocate audit team members resources and expertise to ensure that the audit is adequately staffed and that the team possesses the necessary skills and knowledge to address the identified risk. It is also important to establish materiality thresholds for the audit. Materiality represents the level at which misstatements in the financial statements could influence the decisions of financial statement users. The audit plan determines how materiality will be determined and applied during the audit. The audit plan also specifies the audit procedures that will be performed to address the identified risks and achieve the audit objectives. These procedures may include substantive testing, tests of controls, analytical procedures, and other audit techniques. Overall, the audit plan serves as a strategic tool that guides auditors in their efforts to provide an independent and reliable opinion on the client's financial statements. It ensures that the audit is conducted systematically, risks are appropriately addressed, and audit objectives are achieved, ultimately contributing to the credibility and accuracy of the financial statement. Internal auditors are a part of the client's organization and are responsible for evaluating and improving the effectiveness of the organization's internal controls, risk management, and governance processes. Their work can be valuable to external auditors as it provides insights into the client's control environment and can help in planning and conducting the external audit effectively. When considering the work of internal auditors, external auditors should gain a clear understanding of the roles and responsibilities of the internal audit function within the client's organization. This includes understanding the internal audit charter, reporting lines, and the scope of their work. External auditors should also assess the competence and objectivity of the internal audit team. Competence ensures that the internal auditors have the necessary skills and knowledge to perform their duties effectively, while objectivity ensures that they remain independent and unbiased. External auditors must determine the extent to which they can rely on the work of internal auditors. This involves evaluating the quality of the internal audit function, the specific areas covered by internal audit, and the nature of the work performed. Auditors should review the internal audit program to understand its scope, objectives, and methodologies. This includes assessing whether the internal audit program is designed to identify and test key controls relevant to the financial statements. External auditors should be aware of the limitations of internal audit work. While internal auditors provide valuable insights, their work is not a substitute for the external audit, and external auditors must perform their own independent assessment. It's important to note that while external auditors can rely on the work of internal auditors to some extent, they ultimately retain full responsibility for the external audit opinion and the accuracy of the financial statements. Compliance with auditing standards and regulations, including those related to considering the work of internal auditors, is essential to ensure the integrity and quality of the audit process. Auditor-employed specialists and auditor-engaged specialists refer to individuals with specialized knowledge or expertise who may be involved in an audit. The key difference between the two lies in their employment relationship with the auditing firm. Auditor-employed specialists are individuals who are employed by the auditing firm itself. This means that the specialist is a direct employee of the audit firm, and their role is to provide specialized expertise for various audit engagements. Auditor-employed specialists work within the audit firm and are part of the firm's staff. They're available to support multiple audit engagements as needed. These specialists are subject to the policies, procedures, and quality control measures of the auditing firm. They are expected to adhere to the firm's professional standards and ethical guidelines. Auditor-employed specialists are often available for consultation on a wide range of audit engagements and may have in-depth knowledge of the firm's audit methodologies and processes. Whereas an auditor-engaged specialist is an external individual or firm with specialized expertise who is engaged by the auditing firm or the client on a specific audit engagement. They are not direct employees of the auditing firm. Auditor-engaged specialists are hired on a case-by-case basis to provide their expertise for a particular audit assignment. Their compensation and terms of engagements are specifically specified in a contract or engagement letter. These specialists are not subject to the policies and procedures of the auditing firm as they are external to the organization. However, they are expected to comply with auditing standards and ethical guidelines relevant to their work on the audit engagement. Auditor-engaged specialists may have specialized knowledge or skills that are not readily available within the auditing firm. They're specifically brought in when the audit team requires specific expertise that is not part of their usual skill set. When external auditors use specialists who are hired or employed by the client, they have specific responsibilities to ensure that the audit is conducted effectively and in accordance with the auditing standards. Client-employed specialists may include experts in various fields, such as valuation professionals, engineers, or IT specialists. Regardless of whether the specialist is auditor engaged or employed or client engaged or employed, the auditors have responsibilities when using these specialists. Audit Guidance provides a framework for how auditors should utilize the work of these specialists in the audit process. For example, the audit team must assess whether there is a need for the specialist in the audit engagement. This assessment is based on the complexity of the audit, the areas requiring specialized knowledge, and the availability of such expertise within the audit team. Auditors must also ensure that the selected specialist possesses the necessary competence and objectivity. This involves verifying the specialist's qualifications, experience, and independence from the client's management. Auditors should clearly define the scope and objectives of the specialist's work. This includes specifying the tasks the specialist will perform, the data or information they will use, and the deliverables they will provide to the audit team. Auditors are responsible for supervising and directing the work of specialists. This includes providing guidance, instructions, and oversight to ensure that the specialist's work aligns with the auditor's objectives. Auditors are required to evaluate the findings, conclusions, and work performed by the specialist. This assessment involves considering whether the specialist's work is consistent with the audit objectives and whether it provides sufficient and appropriate audit evidence. The work of specialists should be integrated into the overall audit process. Auditors must ensure that the specialist's findings are appropriately coordinated with other audit procedures and that any implications are considered in forming audit conclusions. Auditors are required to document the use of specialist services. This includes documenting the basis for selecting a specialist, the scope of their work, the results of their work, and the implications for the audit. For audit specialists, auditors should evaluate the specialist's independence and objectivity. If the specialist's work is affected by conflicts of interest or bias, this should be addressed appropriately. Using the work of audit specialists and company specialists can enhance the quality and effectiveness of the audit process by tapping into specialized knowledge and expertise. However, auditors must exercise due diligence in selecting, supervising, and evaluating the work of these specialists to ensure that it aligns with auditing standards and contributes to the overall audit objectives. Time budgets play a crucial role in audit engagements for several reasons, helping auditors plan, manage, and execute the audit efficiently and effectively. Time budgets help auditors allocate resources, including personnel and hours, effectively. By estimating the time required for each audit engagement or task, auditors can assign staff with the appropriate skills, and experience to each aspect of the audit. Time budgets also serve as the foundation for project planning and scheduling. They provide a structured framework for organizing audit tasks, setting milestones, and creating timelines, ensuring that the audit stays on track. Auditors can use time budgets to manage their resources efficiently, preventing over-allocation or underutilization of audit staff. This helps optimize the audit team's productivity and ensures that critical audit procedures are not rushed due to resource constraints. Time budgets allow auditors to communicate realistic expectations to the client regarding the duration of the audit engagement. This transparency helps manage client expectations and minimize surprises related to the audit timeline. Adequate time allocation in the budget is essential for maintaining audit quality. Rushed audits due to time constraints can lead to oversight, errors, or missed audit procedures, which can compromise the integrity of the audit and the reliability of the financial statements. Time budgets also aid in risk assessment by identifying critical audit areas and allocating sufficient time for their examination. High-risk areas may require more extensive testing and analysis, and time budgets help auditors prioritize these areas. Many auditing standards and regulations require auditors to plan and perform audits in accordance with time budgets. Auditing standards require auditors to plan and perform audits in accordance with time budgets. Adhering to these standards is essential for maintaining professional ethics and compliance. Additionally, time budgets provide a basis for audit managers and partners to review and assess the progress of the audit engagement. They can compare actual hours spent to budgeted hours and identify discrepancies or areas needing attention. This is an important review and quality control. Time budgets contribute to cost management by helping audit firms estimate the direct and indirect costs associated with an audit engagement. This information can be valuable for pricing audits, managing overhead, and assessing profitability. Properly documented time budgets serve as a record of audit planning and allocation of resources. This documentation demonstrates due diligence in audit planning and can be useful in the case of regulatory inquiries or legal disputes. Time budgets also provide the basis for client billing. Audit firms often bill clients based on the hours worked by audit staff, and time budgets help ensure that billing is accurate and reflective of the actual effort expended. After an audit engagement is completed, a review of the time budget can provide insights for process improvement. Audit firms can analyze variances between budgeted and actual hours to refine future budgets and enhance efficiency. In summary, time budgets are essential tools in audit engagements that facilitate effective planning, resource allocation, and management. They contribute to audit quality, compliance with standards, and client satisfaction while helping audit firms manage costs and improve their audit processes over time. Audit documentation, often referred to as working papers or audit files, is the record of all the procedures, evidence, and information collected during an audit engagement. It serves as the official and comprehensive repository of the audit process, findings, and conclusions. The objectives and requirements of audit documentation in audit engagements include evidence of compliance, to provide evidence that the audit was conducted in accordance with auditing standards, regulations, and the auditor's own policies and procedures. It provides a basis for the audit report to support the auditor's opinion on the financial statements by documenting the audit evidence gathered and the conclusions reached. It also aids in planning and supervision to help in the planning and supervision of the audit engagement by documenting the audit plan, staffing, and the allocation of resources. It facilitates review and quality control to allow for the review and quality control of the audit work by audit managers, partners, or external regulators. It also provides a reference for future audits, enabling auditors to understand the work done in previous periods and helping with the continuity of the audit process. In the context of audit documentation and working papers, audit firms typically maintain two main categories of files: permanent files and current files. These files serve different purposes in the audit process. Permanent files, also known as continuing files or standing files, contain information and documentation that are relevant to multiple audit engagements for the same client and are meant to be retained from year to year. These files are considered permanent because they provide a historical record of the client's business and the auditor's relationship with the client. Permanent files typically include such items as the client's articles of incorporation or organization and bylaws, previous year's financial statements and audit reports, legal agreements and contents of significance, information related to the client's organizational structure and ownership, minutes of meetings of the board of directors or shareholders, reports from previous year's audits including any unresolved issues, important correspondence and communications with the client, background information on the client's industry and regulatory environment, any significant non-financial information that provides context for the audit. The primary purpose of permanent files is to provide auditors with a reference point and historical context when conducting subsequent audits for the same client. They help auditors understand the client's business, its regulatory environment, and any significant events or issues from prior years. Current files, also known as working files, contain documentation that is specific to the current audit engagement. These files are created and maintained for each audit period. Current files typically include items such as the current year's financial statements and related schedules, the audit plan including the scope and objectives of the audit, detailed audit programs outlining specific procedures to be performed, evidence of tests and procedures performed during the current audit, such as sample selections, analytical procedures, and substantive testing, management representation and confirmations obtained during the audit, any issues, findings, or adjustments made during the audit, the draft and final audit reports for the current year, correspondence and communication related to the current audit, any other documentation specific to the audit period. The primary purpose of current files is to document the procedures performed, evidence obtained, and conclusions reached during the audit engagement for the current year. These files serve as the basis for the audit opinion and provide a detailed record of the audit process. It is important to note that while permanent files are retained and updated from year to year, current files are typically archived once the audit is completed and finalized. The separation of permanent and current files helps auditors maintain an organized and efficient documentation system, ensuring that historical information is readily available when needed, while also maintaining the confidentiality and security of current audit information. Audit documentation should be prepared so that it provides sufficient detail to enable an experienced auditor having no previous connection with the audit to understand the nature, timing, and extent and results of audit procedures performed. The documentation should be organized logically, it should be well structured and indexed to facilitate easy access and review. It should follow a consistent format that allows for easy navigation. The audit plan, including the audit objectives, scope, and procedures, should be documented. This plan should guide the audit team throughout the engagement. Audit documentation should contain evidence obtained during the audit, such as financial statements, supporting documents, audit tests, and findings. It should also document any disagreements or unresolved issues with the client. The auditor's judgment and decisions, including the basis for materiality thresholds, should be documented. Any significant judgments or estimates made by the auditor should also be recorded. Documentation should also include responses to assessed risks, including the identification of risks, the auditor's assessment of the risk, and the procedures performed to address these risks. Audit documentation should include any significant matters communicated with management, those charged with governance, and other relevant parties. This includes any disagreements or uncorrected misstatements. Audit documentation should be completed within a reasonable time after the audit report release date, but before the report is issued. It should be assembled promptly after the audit is completed. Audit documentation should be retained for a specific period as required by auditing standards, which is typically several years. It should be kept confidential and secure. Audit documentation should be subject to review and approval by audit managers or partners to ensure its accuracy, completeness, and compliance with auditing standards and the firm's policy. If audit documentation is maintained electronically, appropriate safeguards should be in place to protect the integrity, confidentiality, and availability of records.